Friends, welcome back. And this session, we are going to learn about computation of cost of preferences. By this time, we have already learned how to compute cost of equity, cost of debt, cost of reserves. Let me share my screen with you. You might be aware of what is a preferential. Just give me a moment till I open my screen. Yes, I think screen is visible to you. So let us first of all learn some of the features which has got these are the features of preference share, and this has got some impact on cost. Preference dividends are guaranteed. It is predetermined. People, when buying preference share, they know this is the type of dividend they are going to get. So suppose it is a 9% preference share, so dividend rate will be 9%. So preference dividends are guaranteed, or in a sense, they are predetermined. Preference dividends are not tax deductible. What does it mean? This means these are not an expenses for income tax purposes. We have already understood the concept of debt. At that time, we have seen when interest is paid as a cost of debt, that reduces the profit and consequently there is a tax saving. So for income tax purposes, interest is an expenditure because this is paid to outsiders. But if money is paid to the not to the outsiders but the owners, then this is not an expenditure. This is a reward to the owner. Preference shareholders are treated like owners. They got preferential right, but they're still the owners of the company. They are not the outsiders. So on that logic, whatever money is paid in the form of dividend to preference shareholders are not deductible as an expenditure for income tax purposes. And in case of redeemable preference shares, the principal also has to be paid back. That means redeemable preference shares actually cash flow wise, they behave just like a debt. So fixed dividend is paid, and finally the that share is redeemed. Okay. So now you look at this chart, you'll be able to understand how to compute the cost. If they're redeemable, preference shareholders are redeemable, then you can compute the cost just like a debt. We can compute the IRR, that is internal rate of return of the cash flow. Or what you can do, we can apply the shortcut formula. Shortcut formula, in the cost of debt, we have already understood. Interest per annum plus average other costs per annum, whole divided by funds deployed. That is opening balance of debt plus closing balance of debt divided by 2. So by using that shortcut formula, we'll be able to compute cost of debt. And here, if it is a redeemable preference share, since the cash flows behave like a debt, so by using that formula also, cost of preference shares can become. If it is irredeemable, then this has to be treated just like an equity. So cost of preference here will be dividend by P0 plus G. In case of equity shares, we are taking D1 by P0 plus G. That means future dividend. But in case of preference dividend, dividend is constant. They do not change from year to year. So what is D0? That is equal to D1, that is equal to D2. So instead of D1, we are writing only D by P0 plus G. Here is a question for you. A company has issued 40,000 12% redeemable preference shares at rupees 100 each at a premium of rupees 5 each. Redeemable after 10 years at a premium of 100 each. Redeemable at premium, that means 100 rupees will be redeemed at 110. Okay. And rate of interest is 12%. Quotation cost is 2. Compute the cost of preference. Okay. Now you see, if you analyze the question, it has these components. Preference dividend is how much? 12%. 12% of 40,000 into 100. Total 4,80,000 rupees is paid as preference dividend. Rotation cost is rupees 2. So 40,000 into 2 is 80,000. So net proceeds will be 42 lakh minus 80,000. Comes to 41 lakh 20,000. That is the net proceed. Okay. The redemption value will be how much? Since there is a premium of 10 rupees, so redemption value will be 40,000 into 110. It comes to 44 lakh. Now, with this data, let us compute what is the cost of a preference. Formula is very simple. Dividend. Here, dividend means per annum plus average other costs per annum divided by average bonds. Okay. By using this formula, you'll be able to compute the cost of preference. Look at here. Dividend is 4,80,000 plus average other cost is how much? 44 lakh minus 41 lakh 20,000. Okay. 44 lakh is the full value, but consideration you are getting 41 lakh 20,000. The difference is the cost for the entire life. And life is 10 years. So average other cost is equal to 44 lakh minus 41 lakh 20,000 whole divided by 10. Then the entire money is to divided by, with average fund deployed, that is issue price plus redemption price divided by 2. Redemption price is 44 lakh, issue price is 41 lakh 20,000. Whole divided by 2. So if you come to do solve this equation, you'll be getting the rate or the cost of preference share is 11.92%. I think you have understood this. This is how cost of preference has to become. Alternatively, you can calculate like this. Here, this calculation has been done in totality, but individually, if you see. So 12 is the dividend plus 110 is the redemption price, issue price is 103, whole divided by 10. Then the entire money is again whole divided by 110 plus 103 by 2. It will also come 11.92%. That's the cost. If there is some other financial instrument, that cost can be computed simply by computing IRR of the cash flows involved with that particular instrument. So friends, we have now completed the computation of preference share. Now we'll be at the last part of your module 2, which talks about weighted average cost of capital. Weighted average cost of capital means what? Each component has got a cost. Each component of capital has got a cost. Now we'll be assigning weight to them. Some weights on the basis of their value. Suppose equity has got a cost, debt has also got a cost. If capital structure, debt and equity is half, can say 50%, weight can be given to each. Okay, so weight into cost is the weighted cost. And this weighted cost average is called as weighted average cost of capital. You'll be able to understand if you look at this example. First, you read this basic things. When you see weighted average cost of capital, it's the composite capital or overall cost of capital. You can call it as overall cost of capital or composite cost of capital. It's the weighted average of costs of various sources of funds, weights being assigned in the proportion of each source of fund in the capital structure. We see what is the proportion of debt in a capital structure and what is the proportion of equity in the capital structure. Accordingly, we assign weights to them. Right? Weight into cost, we get weighted cost. Then that weighted cost is averaged out to compute weighted average cost. Now, Here is some, okay, few more things. Why we compute weighted average cost of capital? It helps us to arriving at a single discount rate. Discount rate means if we evaluate the project, we have to discount the future cash flows to compute net present value. And different components of capital has got different rates. So to find out the single rate, we find out what is the weighted average cost of capital. And this weight can be either on the basis of book value or on the basis of market value. Book value weight has got advantages. They're audited, they're constant over here, they're readily available. But disadvantage is that they shows the historical values. They do not really represent the real economic value. Market value represents economic value that talks about the real worth of that instrument, but it fluctuates on day-to-day basis. So for the sake of convenience, most of the cases we take the book value. How to compute weighted average cost of capital? First, compute the cost of individual components of the capital. For example, if the capital has got debt, equity, or maybe preference, each component's cost has to be computed. We know it how to do it. Then assign weights on the basis of book value or market value. Assign weights. Suppose it's equal, so it is 0.5, 0.5, or it is, let us say, 60%, 40%, 0.6, 0.4. On that basis, weights has to be assigned. Then weighted average cost of capital is the sum of weights into cost. Here is an example. If you look at here, you will be able to compute weighted average cost of capital. Let us say book value of equity is 100, book value of debt is 150, total is 250. First, we will be computing cost of each component. So let us say cost of equity is 12%, cost of debt is 8%. So we are writing it in decimals, 0.12 and 0.08 respectively. Once this is known to us, then we'll be first of all assigning weights, then we'll compute weighted cost. Weights, here we are assigning 0.4. On what basis 0.4? Because total is 250, equity is 100. So the ratio of equity is 40%, therefore 0.4. And the ratio of debt is 60%, therefore 0.6. Always assigning weights, do a total. Find out if it is 1, that means your weight is correct. Now, once we know the weight, next thing is that this is cost of capital, this is weight. Just multiply them. So weight into cost of capital. If you're multiplying, you are finding first case, it is coming 0.048. Second case also, it is coming 0.048. So overall cost will be the total of these two. It is 0.096. Or if you want, you can multiply it percentage. Multiply it 100 and get 9.6%. Okay. How weights are to be calculated? It is given below. Equity's weight is 100 divided by 250.4. Debt's weight is 150 divided by 2.6. That means how you are getting this 0.4? 100 divided by 250. How we are getting 0.6? 150 divided by 250. Okay, once we know the cost, once we know the weight, then we'll be able to compute the weight into cost and just take the sum of that, we're getting weighted average cost of capital. Quickly see one more question. These are the following capital structure you see. Equity is this much, 40 lakh. Preference is 10 lakh. Debentures is 30 lakh. Total is 80 lakh. Okay, then some data is given. The company sales equity shares at 30 rupees. Expected that the company pay next year dividend, which is D1 is 2 per share, will grow at the rate of 7%. The G is 7%. Assume 50% tax rate. Compute what? So if you follow the formula, first you have to compute the components of cost of each component. So cost of equity, you see D1 by P0 plus G is computed to 13.67%. Cost of preference is computed like D1 by P0 plus G, it comes to 10%. Debt cost is 14% for post-tax cost of debt is pre-tax cost of debt into 1 minus tax rate, it is 7%. Okay, now you assign weights. Okay, weights are assigned 0.5, 0.125, 0.375. Try to understand how the weights are assigned. In the same way, which is explained to earlier. 40 lakh divided by 80 lakh, it comes to 0.5. 10 lakh divided by 80 lakh, it comes to 0.125. Then 30 lakh divided by 80 lakh, it comes to 0.375. Now, weights are there, cost is there. Weighted average cost is weight into cost, and total of that work is 10.7. Okay. Hope you have understood how to compute this weighted average cost of capital. Simply assign weights and multiply with the cost of each component of capital. Then take the sum of this multiplied numbers, you'll be getting work. Friends, let us stop our session here today. With this, we're completing our second unit. Next session, we'll be learning about unit 3. Thank you.